Good morning, traders. It is Friday, October 17th. Lots of volatility in overnight trading, but most people will never even know it happened because it happened outside of regular trading hours. If we take a look at the S&P 500, you can see overnight trading, we had a pretty good little sell-off there take place from yesterday's close. The market sold down roughly 1.3%. Nothing huge, but it's still a pretty big move to the downside. Obviously, there's some concerns with credit, and I think a lot of people are nervous. We got the delayed CPI data coming out. So anyway, some selling there. The selling, I think what happened, let's just grab the tool. The selling, where is it? The selling that kind of took place after the market closed, this wave of selling was kind of carry over from yesterday. So we saw the markets gap higher and then it just sold off all session. We saw panic selling. When we look at our panic selling indicator, panic selling closed a relatively high 4, and that can create overnight feeding frenzy or sell-off frenzy overseas. People get nervous and now today we're starting to see the markets get bought back up. So when we look at this bar here, we got this big flush down in futures and it's rallying back up. So it looks kind of like a bottoming tail, or it's it's trying to find some support. It got sold off but bounced right back. And this is kind of this pattern. It's really volatile. I'm not a huge fan of it. I know some of you were wondering about the energy trade, which I'll touch on in a minute, but let's take a look at the NASDAQ real quick too, just so you can see what it did percentage-wise. The NASDAQ ended up dropping about 1.5%, and of course it's regained. So the markets right now are right back to where they were. They're pretty much flat, but most people won't realize there was a flush out and a running of stops probably overnight, and people kind of getting shaken out there. Money is still somewhat flowing out of stocks at this moment, but obviously they're bouncing in pre-market and maybe they want to go higher. We are seeing money move into gold. Now, there's a lot of volatility here in the precious metal space as well. We saw gold run up over 1% last night, and now it's pulling back a little bit. We have silver. If we take a look, it's almost down 3% today, so it pushed up a little bit higher in overnight, and it's pulling back. So we're starting to see a little bit of shift in volatility, that money's coming out of gold and now going into stocks. And all this is really happening just in the last few hours this morning, really. So we'll see how all this shakes out. Lots of jitters, economic data. It's Friday, the market, a lot of people are going to want to get back to cash and rebalance. They're not going to want to hold positions over the weekend. So probably a big volume day across the board of people just covering their shorts, people getting out of their longs, depending on what side of the mindset or of fear they're on, panic of losing or panic of missing out. So let's take a look at a few other things. Bonds real quick. Let's just focus on the daily chart. Bonds had a nice push up this morning and they're pulling back a little bit. Again, the trend for bonds temporarily here is to the upside and it's moving upwards. We're seeing the dollar a little bit higher this morning, not much. It's been pulling back the last few days, settling down into the middle of all this range here in the 50 and 20 day. So we'll see if it ends up finding some type of support bottom. If we take a look over at crude oil, it flushed down even lower again this morning, right down into the $56 per barrel. I mean, we were talking about this way over here and this blow-off spike news, this news-driven move. I remember this changed a lot of people's opinions. We had the bombs being dropped, and we had this huge pop and spike, and I was letting everybody know, like a lot of people at this point, we're talking about $100 and $125 oil. It's amazing how one piece of news hits the market and everybody thinks everything changes. And I talked about once this fizzles out, this news will just disappear. So you don't want to count those moves. So more or less the oil moved down, went into a bounce, and then it's heading back down to these lows. And this is the big question is, can it hold these lows over the next month or so? It's probably going to bounce and trade down here for a while. And then if it does start to break down below these levels, then it's bombs away for another leg to the downside. But right now, a lot of you are talking about the inverse energy trade. And I mentioned yesterday that I wasn't a fan of it. Right now, I'm just not feeling it. Again, a discretionary trade for me has to feel good across the board. Not only does it have to look good, but I have what a lot of you might not have, which is that kind of sixth sense of what the markets are doing from lots of experience. And I get to feel the emotions and what everybody's thinking and doing through emails and phone calls and all of that stuff and comments. And so if we were to look at the energy trade, just keep in mind, oil has now come down and hit our downside target. So oil is technically at support, which means it could bounce. The stock market has this potential bottoming candle. We talked about how it's in this no man's land, inside bars, inside this red bar. It's usually a bearish pattern, but it's inside here, and we just need to let it figure out what it's going to do. And I don't want to jump into anything when we're stuck kind of right in no man's land. It could break either way. So if it does rally, obviously we don't want to be inverse energy stocks, because we are still in a bull market. If we look at the TTI strategy, the technical investor, we're still in a bullish upward trend. And so we don't generally want to take inverse ETFs unless the stars are aligned. Now, the ERY one could be one we still take. I'm not taking it right now. I want to let the charts continue to mature. So let's just take a look at the energy stock ETF XLE. It has had a series of, it's had a drop, it's had a bear flag, it's had a drop, it has potentially a bear flag. Let's just see what it's doing in pre-market in the 10-minute chart. So it is trading higher this morning. So it's still in this bear market phase and letting it kind of do its thing. So I'm not too interested in it for those reasons. If oil bounces and the stock market does break to the upside and the technical longer underlying trend is still up, I do need to not only see a good chart, but I have to feel it as well. And it's part of discretionary trading is you have your rules and things, but still things need to align. And this is what sets me apart from most other traders is just because I see it and I want to take it doesn't mean I'm going to take it. And people want trades, and when you see something like this, you can, generally people will just jump at it. But there's an extra layer that it has to pass in order for me to take that trade. And I don't mind if it breaks down and drops and it goes. It's not the end of the world. I mean, there's going to be another opportunity. There's potential we can get another player bounce later for when the stock market is clearly in a downtrend and we have a bounce and pause in the energy space. So again, there's always going to be more opportunities, and it's not about trying to take advantage of everyone just because we want to, right? It looks good, but I still don't think it's ideal just yet. If we take a look at miners, they had a very nice big pop and run. It's starting to have these big gaps and expansions on big price action. We can see gold stocks have a big gap down. They're trading lower today. Pretty much all of yesterday's gains are wiped out. We're right back to where it was before that. So there's a lot of volatility in this space. And we just need to be prepared for the markets. They're going to be like this more often. As things start to rocket higher, we have big up days, big down days, big gaps, and we just need to let it continue to unfold and try to figure out when the market is putting in a major top or not. About gold, a member is asking about, they bought in 2013, 2014, they're up pretty nicely, and they're wondering if they should lock in profits. They want to hear my overall balancing of the asset versus trading and having it as some type of hedge. Again, gold for me of my whole net worth is a very small sliver. Things have kind of really expanded, and so gold is kind of a very small sliver, small percentage, probably 3-5% tops of my overall net worth. So I look at gold as it's just been a long-term play for me when I go to gold. It's been a hedge. It's been an insurance plan. I've had it since the new breakout in 2019, which if I just go back a little further, 2019, and now we're into this parabolic phase. So for me, I see even my long-term position at this point feels like more of a trade, which is why I'm looking to rotate out of it and lock in some gains and potentially buy gold back after it has a pullback. And because it's not like I'm going to hold on to it as a hedge. Even if gold skyrockets higher, it's not really hedging my other assets. It's still a small sliver. It's more so of a trade. And as we know, if we take a look at this last run here from where it is right now, this is showing that the retracement level for gold. If it was to come back down using Fibonacci retracement, typically it wants to come into the middle of these areas. So we could see the market pull back, potentially 30, 34, 34%. This is what it's pulled back in the past. So it could come back down and flush this whole area out, this last leg higher that I believe is on right now before we see everything kind of top. I think the market will give that back and break these lows and flush down in this area. In 2007, 2008 crisis, we saw it drop 34%. So again, it could come down and reset this, and then it would be a new opportunity for me to get back into gold and silver and physicals for another long-term play. So that's how I'm seeing it. I know many of you have massive amounts of gold, silver, and mining stocks. You're heavy weighted, you're hedging for some of you the end of the world, more or less, but which there's nothing wrong with that. It's just that's not my position, and I'm not counting on it. In fact, to me, if you're super duper heavy weighted in the precious metal space, to me, I'm like, you're huge in the profits. You've got massive growth. I'd be locking in and protecting some of that. That's what I would do that. I'm doing that anyway. It doesn't matter how big or small your position is. The last thing you want to do is see a huge chunk of your wealth just drop when we do have clear signs that we're about to see probably a very sharp correction in the stock market, very sharp correction in precious metals. It's easy to get caught up though. Everybody is very bullish, perma-bull on gold. If you're in that space, that news will keep you into the metal, so just be cautious. And when you step back and you look at the big picture of silver, like it doesn't take a 5-year-old could say what usually happens after this type of price action, right? And this is what happens. The dollar's out of favor. Everybody says this is just the beginning. Things are going to go crazy. Everybody's piling in. Usually it ends with a big red bar. It's just a question of where does that red bar start. So again, I'm all about protecting and growing capital, not about riding a roller coaster. I like to ride a roller coaster up, but I do not like to take it down. And that is why I'm slowly trying to prepare everybody to make sure you lock in some profits, enjoy the profits, and not feel like, don't worry if you get left behind a little bit. It's not the end of the world. But you definitely don't want to give back a huge chunk. That can happen literally in 1 month. 1 month you can drop 20, 30, 40% in some of in silver. It's pretty crazy how quick it moves. Another member wanted to know about the dollar. I think I may have touched on this already. I think if you're a Canadian, he was talking about he's Canadian. I believe in holding the US dollar because I do think the dollar is rounding out and it's starting to turn higher. If we look at the dollar and the Canadian dollar currency, you can see it's put in a pretty clear rounding bottoming formation. It's moving up and to the right. So if you hold US dollars and you're a Canadian, then the US dollar is going up in value. At some point, we'll want to rotate out of the dollar and buy the Canadian dollar, and the US dollar will fall and the Canadian dollar will rally. But that's after the stock market and we have a huge reset of some sort. So that's kind of my view and take there. One of the members is saying they're really confused about the gold position, how we got out of the short term, the gold trade, which was in PHYS, the Sprott Gold Fund. They're confused. They're wondering how does it work into the portfolios of TTI, of ACS, and the band strategy. They're trying to figure out how all that works. I have tried to explain this many times, but the discretionary, the bonus trade in gold is just that. It's not in any of those portfolios. They're not part of that service. It's just, here's a trade I'm taking on the side because it's like a perfect setup. I want to get involved. I'm in it, make some money, get out, and then just forget about it. But people don't want to forget about it. We have a ton of comments yesterday, people saying, I'm still in that trade. I don't want to get out. I believe it's going a whole lot higher. I believe this is a long-term trade. And this is the problem that happens with so many traders. I see this endless. You get into a trade and it works, and then you suddenly fall in love with it. It's like the woman in the red dress. You fall in love with it, and then suddenly you don't want to let it go, and you turn a trade into a long-term investment, and you hold it up, and then you keep holding it when it reverses and crashes, and then it doesn't work as a long-term play anymore. You're now underwater, and it's a big loss. So this is the problem with putting too much thought into a trade. That's why we have rules. You set your trade, you hit your target, you get out. If it keeps going without you, you're like, well, I nailed that trade, and it even had some extra upside. So I picked a good trade and nailed it. But you don't have to have the whole thing. So that's kind of the scenario you have to remember. Any discretionary trade does not fit in any of my portfolios, and gold is just a trade, and we're in and out. Last but not least, take a look at Bitcoin. Down again today, down another 2.5%. Bitcoin doing we were looking at getting into a Bitcoin trade. It got really ugly, and it did exactly what we don't want it to do, which is to run up, make a new all-time high, get you really excited about it, get you in, and then roll over and die. And it breaks this low, it's broken that low. It has now more so done an impulse wave. It's broken 2 previous lows, and when we do break 2 previous lows, usually the first pause or pullback against that trend is usually the opportunity for it to have the second half of that move down. So again, it has gone from a fake out, which is what it looked and felt like, and why I was telling everybody, I'm not taking it. I don't like this. This does not look trustworthy. So it's gone from a fake out to now, potentially a downtrend here going forward. Anyways, that's it for this morning. We'll talk to you soon. Take care. Bye-bye.